It's Black Friday, in case you hadn't noticed, which is apparently a big retail shopping event. Can you tell me what are the biggest bargains that you see in markets at the moment, then?
You'd say that bargains might stay bargains. I mean, oil looks like a bargain down here. It looks like a savage reduction. It might get cheaper sometime between now and Christmas. Maybe, you know, we do Black Friday more than once before Christmas, but oil looks cheap. Some of the emerging market currencies are very cheap, but likely to stay so. So, you know, the Turkish lira is still pretty much the cheapest place you could go and buy a cup of coffee in the world at this point. And,
right.
And you know, they still have some sunshine left, a little bit left still in the south. So some of those are still a bit cheap. But, you know, I think what markets tell you is that things can be cheap and stay cheap. The bargain, you know, you might make your money back in the second half of next year. And the big one, the euro is cheap. It's not going to pay you dividends, I don't think, until the second half of next year. OK, so things that are interesting then. So things that you've identified quite a lot of things that are cheap, but it doesn't tell us much really about whether they're going to stay cheap, as you rightly point out then, Kit. One thing I was drawn to in your notes, though, which I thought was really interesting, and this links nicely with this weaker oil price we're seeing, is the way that this ties in with the five-year inflation expectations in the US and then into Treasury yields as well. Do you see that link? Because Treasuries seem pretty unmoved, really. I mean, yes, we've seen yields coming down a bit recently, well, but not to the extent that we've seen stocks selling off. No, but we've seen yields coming down, inflation break-even rates coming down on tips, and so real yields are holding up rather more. But you've also seen, you know, your guests coming in and a narrative coming into the market about is this the sort of the beginning of the end of the economic cycle? The market's rethinking its expectations of how many rate hikes or its confidence about US rate hikes come down. And I was wondering, certainly yesterday evening, I was sitting wondering, you know, how much of that is we can see oil moves break-even inflation rates and inflation swap rates down. That takes yields, Treasury yields down away from 3.25 towards 3. And hey, bingo, suddenly we add 1 and 1 and we think, yeah, the economy, you know, the moods on the economy is changing. So, well, if all that's happened is oil prices are lower, yes, let's figure out what we think that means.
Right. Yes, and this is interesting. So this is the chart I was scrabbling around to try to find just then, Kit. But this is in relation to your comments there about all these things linked. And so we put them in a chart, as you say, this inflation anchor. So we've got in here the dollar, we've got in here the US 10-year yield. Those are at the top. And then we've got oil prices falling at the bottom. And you can see, I mean, the oil price move does look fairly outsized compared to what we've seen in dollar and in treasuries. What does all this mean for the dollar then? If you think that, is the oil price overdone?
Yeah, so if I really believed that the fall in inflation expectations and in oil prices was the beginning of, was close to the end of the economic cycle, so we're cresting the US cycle in a clear way, I'd probably just want to sell the dollar today. I'd probably want to buy treasuries, sell the dollar, say, look, it's been a great run, but we're going to be talking about rate cuts by, in the second half of next year. My concern is that could be 3, 4, 5, 6 months too early. I mean, my biggest, my fear is we could be messing around in a range with the dollar for the next few months, and I could be buying it and selling it and getting frustrated and annoyed with myself and sort of hoping I don't miss the move.
You have a real fear of missing out this Friday.
Oh, I have a real fear of missing out on Friday. I may pay too much for a Black Friday bargain out of fear that I'm missing something. That has a familiar ring to it in my life.
It does. It does. Stay away from those Black Friday bargains, perhaps. Let me ask you about where the Fed goes then in amongst all of that, with the oil price falling and with expectations of inflation falling. Morgan Stanley talking about how Fed hikes will start to sound more dovish. That is sort of one little tiny baby step, I suppose, on the way to turning the rhetoric from the Fed around a little bit.
Yeah, look, I think we'll get the next one in December, so just round the corner. They're just keeping on going because the data, I mean, they're very, very much driven by the data at this point. But they have made a big deal of neutral. So when the funds rate is 275 to 3, it's at neutral. That's only 3 moves away from where we are today. So I cannot imagine that they plough on regardless and unchecked without changing their rhetoric unless the economy is doing something and the inflation rate's doing something. So to make them. So, if we're all wrong on the economy and it's accelerating in the new year and wage growth is picking up further in the new year, then perhaps. But that seems, I mean, that just seems really unlikely.
This weaker oil price, though, gives them something new to put into that data, doesn't it? Well,
it's going to give, certainly it takes inflation expectations down, as and they do look at the same ones as we do, and it'll give us lower headline inflation. And we've got core CPI is not showing any real pressure at the moment. So The only real inflation we have at the moment is there's been a clear pickup in wage growth in the States. I mean, absolutely unambiguous pickup in wage growth. But that doesn't, you know, as long as there's some productivity in the economy, 3-point-something% wage growth doesn't necessarily mean that core CPI goes much higher.